Hello everyone. இந்த லெக்சர்ல என்ன பார்க்க போறோம்னா derivative analysis and valuation. Okay, first meaning of derivatives. What is the meaning of derivatives? Okay, derivative is a financial instrument. The value of the financial instrument is derived from the underlying asset. The financial instruments means it can be a financial asset or it can be a financial liability. If it is favorable for the investor or a company entity, it will be a financial instrument. Okay, if the investor is investing in the underlying asset, if it is favorable for the investor, it will be a financial asset. In the financial reporting, okay, in case of financial reporting, the financial instrument can be classified as a financial asset or a financial liability. Okay, such as the underlying asset means it can be a stock, index, bonds, commodities, currencies, interest rates. Okay, it can be a equity. Equity means shares and index. Okay, index is a Nifty index or a futures. Okay, it can be a top 50, Nifty 50, or this is called as index. Okay, bonds and commodities, currencies and interest rate. In this lecture, we will be covering equity, bonds, commodities. In case of currencies, that is foreign currency, it will be covered in foreign exchange chapter, that is forex chapter. In case of interest rate derivatives, if interest rate is considered as an underlying asset, then it will be covered in interest rate risk management chapter. Okay, there is a separate chapter for currencies and also interest rates. In this chapter, we will be covering only stock, index and bonds and securities. Okay, next. The price of the derivatives fluctuates based on the changes in the value of the underlying asset. Okay, the price of the derivative, it is a derivative contract entered for the future date. Okay, so during the period, the price will fluctuate based on the value of the underlying asset. Okay, okay, I'll give you the example of what do you mean by derivative contract. Okay, there is a two party in case of derivative contract. Okay, in case of a contract, there is a two party involved. Okay, first one is Mr. A. Mr. A. Okay, Mr. A. Also, we have an example in our case, Mr. B. There is an underlying asset. Okay, shares, bonds, index, commodity. These two are covered in separate chapter. Okay, they are entering into a contract. A and B entering into a contract. Also, the derivative contract is possible only in case two party has a expectation in a different way. The expectation of Mr. A can be a price will increase, the underlying asset value increase in future. In case Mr. B, in case of Mr. B, he has an expectation that the price of the underlying asset will decrease in future. Okay. Example is in case of MRF shares. In case of MRF shares, I will take a example of MRF shares. Okay, the current price of the MRF share is 1,50,000. So the Mr. A has an expectation that price will increase by 2,50,000. Okay, but Mr. B, who has an expectation that the price will decrease to 1.2 lakh. Okay, this is an expectation price. Okay, then they will enter into a contract. Okay, there is a forward contract and also future contract. I will explain it in later. What do you mean by forward contract and future contract? This is the derivative contract example. Okay, so Mr. A will enter into a buy contract. Okay, it is a upside betting. Okay, it is a upside betting. In case of Mr. B, it's the downside betting because he sells the underlying assets. He will sell the underlying asset. He will buy the underlying asset. Okay, so they are entering into a contract on April 2025. There is an in-between period. There the price can be fluctuated. Okay, the future date, that is contract maturity date. The contract maturity date is a future date. Okay, the contract entered date, on the date of entering into the contract, the spot price or a current price is 1,50,000. The current price will be computed. Future price will be computed using the spot price. Okay, using time value of money concept. There's a time value of money concept. There is a formula I will explain. Okay, in while covering the forwards and future. Okay, they will assume there is a prefixed price. Okay, they will compute the theoretical price and they will enter into a prefixed price of 2 lakh. Okay, A and B enter into a contract for a prefixed price, that is 2 lakh rupees. But settlement will be happen on a actual price. Okay, actual price, both the party will not know. There's an actual price quoted on the maturity date. Okay, so I will take an example in a two situation. Okay, first one is if the actual price turns out to be 2,30,000. If the actual prices turns out to be 2,30,000, they are entered into a contract for a 2 lakh rupees, but the actual price is 2,30,000 on December 2025. Okay, computation of gain or loss for both A and B. In case of A, the actual amount, actual price, he has an expectation that price will increase. Okay, actually they have entered into a contract for 2 lakh. The actual price is 2,30,000. He will buy the MRF share from Mr. B. Mr. B sells the shares to Mr. A. So he will buy the MRF shares of rupees 2 lakh. He will sell the shares in the market at 2,30,000. Then he will make a gain of 30,000 rupees. Okay. In case of Mr. B, Mr. B will do, actually he will purchase the shares of for 2,30,000. Then he will sell the shares to Mr. A and will get the amount of 2 lakh. Okay, so 2 lakh minus 2,30,000 will give you loss of 30,000 for Mr. B. Okay, that is the expectation. Okay, in this case, both the party will not know what will happen in future, but in this scenario, Mr. A got a gain. Okay, I will take a second scenario. In this case, if the actual price of the MRF shares turns out to be 1,70,000 on December 2025. Okay, Mr. A, in case of Mr. A, Mr. A will pay the amount of 2 lakh to Mr. B to purchase the shares, which is entered in a forward or a future market. Okay, 2 lakh he will pay. He will sell that MRF share after purchasing the share from the Mr. B. Okay, he will sell the shares in the market for 1,70,000. So he will make a loss of 30,000. The price is 2 lakh. He has entered into a contract for 2 lakh. Okay, 1,70,000 is the actual price. He will pay 2 lakh to Mr. B and he will get a 1,70,000 by selling the MRF share in the current actually quoted date. Okay, actual contract date. Okay, next, Mr. B will receive 2 lakh rupees. Okay, from Mr. A and sell the share at 1,70,000. He will get a gain of 30,000. Okay, he will get a gain of 30,000. Next, in general, the derivative contract is a cash settlement basis. Cash settlement is net cash. Okay, the net settlement 30,000 will be made. Okay, he will get a gain of 30,000. He will pay that 30,000. In this case, he will pay that 30,000 to Mr. B. Okay, in this exchange market, if one person gets a gain, another person will make a loss. If one person makes a gain, another person will get loss. Okay, in the derivative contract. Let's move to notes. Okay, we have discussed what is the derivative contract. Now, the contract to buy, sell the underlying asset on a future date. In our example, the future date is December 2025 for a prefixed price. That is 2 lakh rupees is a prefixed price. The settlement will happen on a actual price. Next, there is a two types of settlement: cash settlement, physical settlement. Okay, In case of cash settlement, the net payment difference between the contract price and market price on settlement date. That is, in our example, first example, we have actual price, that is market price on a settlement date is 2,30,000. So the contract price is 2 lakh. The 30,000 difference between this amount, 30,000 will be settled in case of cash settlement. In case of physical settlement, the shares will be transferred to one party. That is, Mr. A will receive the shares, Mr. B will sell the shares. That is, physical settlement of asset will take place. Okay. What are the types of derivative contract? What are the types of derivative contract? There are 4 types of derivative contracts. First one is forwards. Forwards, it is a customized contract. Okay, it is a customized contract to buy and sell the asset at a future date at a predetermined price, that is agreed price. Okay, they will agree the price on entering into the contract. It will be settled in a future date. Next is, it is a customized. There is a forward. In case of forward contract, both the party will enter into the contract on a face-to-face basis. Okay, that is counter, over the counter basis. In case of future contract, it is a standardized and regularized by the exchanges, that is BSE and NSE. The standardized contract traded on exchanges. BSE exchange, there is an intermediary. BSE and NSE will initiate the contract between two parties, buy and sell the asset at a predetermined future price. Okay, there is a major difference, which is it is exchanged on a over the counter basis. In case of futures, it will be traded on a exchanges, NSE and BSE. Options, a contractor giving the right. In case of options, one party will have a right, another party will have an obligation. In case of forwards and options, both the party has a obligation and also rights. Okay, both the party has a rights and obligation in case of forwards and futures. In case of option, one person will have a rights, another person will have a obligation. But person who has the right will not have the obligation. Okay, if one person want to exercise the option, he can exercise. If he don't want to exercise, he can reject the options. Okay, in this case, one person will have the right, another person will have the obligation. Person having the right is the ultimate decision maker. Okay, on the date of specified date. Okay, in case of specified future date. Swaps. Swaps is the two-party exchange of the financial obligation. Financial obligation can be a interest rate. In case of borrowing, interest rate in India is more. If interest rate in India is more, that is floating or a fixed. There are two interest rates, floating and fixed interest rate. That is, the floating means variable interest rate. If the Indian company wants to take loan at a floating rate, then the floating interest rate can be available in America. Okay, the company in India and company in USA will swap the interest rates to get the gain. Okay, so the interest rate swap and currency swap is covered in forex and interest rate risk management chapter. So in case of swap, it is not covered in this chapter. Okay, derivative valuation and analysis chapter. Okay, we have only forwards, futures, options. Forwards and futures are moreover same. Okay, moreover same concept we will discuss. Next is participants in a derivative contract. First one is hedger. These participants uses the derivative to reduce the risk and eliminate the risk. The hedgers will enter into a derivative contract to kill the risk in case of price fluctuations in the underlying asset. Okay, they will have the shares. First, they will have the shares. Okay, they will expect that the price will decrease in future. So, to hedge the risk, they will enter into the derivative contract to reduce the risk or to eliminate the risk. Okay, they will take an opposite position in the market to reduce the risk. So next example, it is a simple example I have taken. A farmer uses the future contract to lock the price of crop. The farmer will enter into a seller and lock the price. In case of in case of crops, the price will be fluctuated based on the demand and the supply. So they will avoid the losses, market volatility. So the farmer will enter into a future contract to lock the price. That is price to be paid by the seller, buyer. Seller is farmer, buyer is other party. Okay. The simple example. There are more examples for hedging. Speculator. These traders take position in the derivative market to earn the profit based on price movements. Speculator. Speculation is they will enter into a intraday transaction. Okay. They are called as speculators. Speculation business. They will buy the shares and they will sell the shares by getting the gain. Okay. If the price decreases, they will buy. If the price increases, they will sell. So assume high risk. There is a high risk that the price will increase or decrease. They will earn a profit based on price movements. Okay. Example, investor buy the stock option predicting the price in the stock prices. Arbitrageurs. In case of arbitration, take advantages of price differences in the market by simultaneously buying and selling the same asset. Okay, they will buy the shares and also sell the shares. This helps the reducing the price inefficiencies in the market. They will not most of the cases arbitration process will not make losses. They will only get the profit. Okay. Now we'll start with forwards and futures. Forwards and futures. One minute. Okay. Let's start forwards and futures. Forwards and futures. Okay. Forwards and futures. Let's straight away discuss the differences between forwards and future. Forward contract. Forward contract is a customized contract which is done in a over the counter basis, that is face to face. Okay. In case of future contract, it's a standardized and a regularized. It is done in a online platform, that is exchanges. Exchanges are NSE and BSE. There is an intermediary in the future contract. There is a NSE and BSE. Okay. Regulation. Forward contracts are not regulated. Actually, the forward contract are not regulated, and also in case of futures, it is regulated by exchanges, NSE and BSE. Next, moving to in case of settlement. In case of settlement, it is a settled at a contract expiry. Contract will be settled at a contract expiry. It is settled under daily market mark to market settlement. Okay, it will be settled on a daily basis. In case of future contract, on the date of closing the contract, the contract will be settled on a daily basis up to the future date. Okay, up to the future date, the settlement will happen on a daily basis. Counterparty risk. In case of forwards, there are two parties. Okay, there are two parties. So in case either of the party can avoid the settlement, there is a counterparty risk is high in case of forward contract. In case, in our example, we have taken Mr. A and Mr. B, they will enter into a contract for MRF shares. Okay, if the price is decreased, Mr. A don't want to pay the settlement, then there is a high risk that the settlement will not be taken place. In case of futures contract, the counterparty risk will be low because it is handled by the exchanges. There is an intermediary in the future contract. NSE and BSE will act as an intermediary. So there is no risk for Mr. A or Mr. B in case other party rejects the contract. The NSE and BSE will collect the amount from the investors as a premium or a margin, initial margin. Okay, liquidity, it has a low liquidity. In case of exchanges, the contract can be settled on a yearly basis, or a yearly settlement can happen in a exchanges. Okay, margin requirement, there is no margin required if the contract is not specifically given. Okay, in case of forwards. In case of futures, the exchanges is requires investor to deposit initial amount, and initial margin should be kept, and also maintenance margin also there. We will discuss it in a while. Okay, usage, used by businesses for hedging, used by traders, speculators, investors. Futures are used by traders, speculators, and investors. Speculators are intraday traders. They are also called as traders. Okay, pricing of forwards and futures. Okay, the same procedure, same formula can be used for forwards and futures. Okay, the price of forwards and futures is determined based on cost of carry model. Cost of carry model means there's an interest rate. Okay, cost to carry. Cost to carry means if you are holding any asset, okay, then you are required to pay the interest amount in case of shares. Okay, while determining the price, there is a cost for the future price, so it will be included in the current spot price. The cost of carry included in the spot price, then there is a theoretical price will be computed. Okay, I'll read this. The price of forwards and future contract is determined based on cost of carry model, which considers current spot price and the cost of holding the asset until the contract expiration. Okay, contract expiry வரணும் நம்ம வந்து அந்த அசெட்டை வச்சிருக்கிறதுக்கான ஒரு cost can be a interest or a interest, and also in case of income will be deducted, cost will be included. Okay, current spot price, and also cost of holding the asset until the contract is expired. How to value the future contract? There is a fair price and also actual price. Actual price is price, the current market price on the date of settlement date. On the date of settlement date, the price is actual price. In case of fair price will be computed using the formula theoretical value. Fair value is computed using fair value, that is future price. Okay, it is a simple only. It is a time value of money concept. Okay, we have spot price, we have to compute future price. So in case of computing the future price, we have to use the formula. Okay, there are three methods to compute the interest. First one is simple compounding, and also continuous compounding and monthly compounding. The interest is, in case of nothing is given in the question, we have to use simple interest compounding. Simple interest compounding means we have a spot price and also spot price into R into T, that is interest rate into time. What do you mean by F? The forward price or a future price. We have to compute forward or a future price, that is theoretical price. In the question, they can ask us what is fair price or a theoretical price or a future or a forward price. Okay, so to compute this, we have to use the formula. Yes, is the spot price of the stock or an index. It can be on a stock or an index. The investor can enter into a derivative contract for a stock or an index or a bonds. So we have to use the spot price into 1 plus R into T. 1 plus R into T. What do you mean by 1 plus R into T? It is a simple formula. It can be also written as spot price plus spot price into R. Okay, into rate and time. Okay, this will give you same formula can be used. Okay, it will simply we will be writing this as a 1. Okay, instead of writing spot price in the formula, we'll be writing 1 in the formula. Okay, S into 1 plus R into T. What is R? It is a risk-free interest rate. It will be given in the question, and also time to maturity in years. Okay, it will be written in years. In case it is for 6 months, means we have to write it as a 0.5. Okay, 0.5, or in case it is for 12 months, then we have to write 6 months means 0.5. Also, in case of quarterly period, then 0.25. Okay, in case of 9 months, we have to write 0.75. Okay, the interest rate is for per annum basis, so we will be taking it as a time to maturity. In case of continuous compounding, e power rt, e power rt will be given in the question. Okay, the e value is computation is not required for you. Okay, it will be directly given in the question. Okay, e value will be given in the question. Okay, the simple method. Next is monthly compounding. In case of monthly compounding, you have to you have to give more attention. In case of monthly compounding, the formula will be more critical. Future price equal to spot price into 1 plus R divided by N. There is a N, that is 12. 12 will be written in both the root power and also in R divided by 12. So then automatically it will be converted into month basis. Okay, it will be converted into monthly basis. So we will be using annual per annum rate divided by 12. Then it will be per month basis. Per month basis will be computed based on 12 into time. 12 into time means 12 month into 6 month means we have to write 0.5. So 12 into 0.5 will give you 6. So power is 6. Then the interest rate automatically converted into 6 month period. You can also compute by dividing the interest rate per month basis. Okay, this is per month interest rate and also just 6 month. Next, N. In this case, N, the number of compounding period per year will be N is for 12-month compounding. Okay, if you remember this formula and also how the formula is created, you will understand. Then it is very simple. Keynote: pricing a formula with the dividend. In case the stock or index pays the dividend, in case stock or index pays dividend, we need to adjust that dividend from spot price. Okay, in case the dividend is paid by the shares or a index, then we have to deduct the present value of dividend from spot price. That is, if the dividend is paid on a face value, there is a 2 examples. In case of the dividend can be paid on a face value basis, or the dividend can be on a yield basis. If the information given in the question is on a face value basis, what we have to do? We have to deduct the present value of dividend from S, that is spot price. So the formula for future price in case of dividend is paid. So future price equal to spot price minus present value of dividend into 1 plus RT. That is for a first form. In case of simple interest, we have to use 1 plus RT. In case of continuous compounding, we will use the e power RT. In case of monthly compounding, we will use the formula as a 1 plus R divided by N whole power N into T. So to compute the present value of dividend, what formula we need to use? In case of simple interest, we will use 1 plus RT. The same 1 power R 1 plus RT will be dividend divided by 1 plus RT, or it can be computed using present value factor. If the present value factor is given in the question, easy part. What do you mean by present value factor? 1 divided by 1 plus R into T will give you the present value factor. In case the present value factor is straight away given in the question, then you have to multiply with the present value factor. Okay. In case the present value factor is not given, you have to dividend divided by 1 plus R into T. That will give you the present value. Okay. In case of continuous compounding, e power RT, the plus signs without minus sign is given, then we have to divide d divided by e power RT. In case the minus e power RT is given in the question, we have to multiply with d. That is, it is straight away given as called as present value factor. Okay. Monthly compounding. In case of monthly compounding, dividend divided by 1 plus R divided by N into whole power N into T. Okay. Next, in the given case, T means number of days or a month after which dividend income will be received. In some questions, the dividend period and maturity period will be different. So you have to use T, which is applicable to dividend. Okay, dividend can be paid in 2 months, but the maturity period is 3 months. Then you have to use 2 months for dividend computation in the formula. Okay. In some questions, they will give you the details of the dividend will be paid in 2 months, but in case of maturity period, for computation of future value, we have to use 3 months for the future price computation. Okay, there is a T will change in case of future price computation and also present value of dividend computation. Okay, ICAI will not ask you simple question, right? So it has to tough the question. So the T will not be the same. Okay, in case of dividend, the dividend will be paid or received, paid by the company within 2 months, means we have to use 2 months for T computation. In case of maturity will happen at 3 months later. So 3 months and 2 months will be different. So we have to use the different period for the computation. Note, give more attention while determining number of months for future contract and also dividend. It will differ in some question. Okay, question specific notes வந்து கொடுத்திருக்கேன். So exam அப்போ last day அப்போ நமக்கு அந்த points அந்த adjustments வந்து நமக்கு நல்லா ஞாபகம் இருக்கும். கொஸ்டின்ல வந்து டிவிடெண்ட் பீரியட் வந்து வேறையா இருக்கு, அப்புறம் ஃபியூச்சர் கான்ட்ராக்ட் பீரியட் வேறையா இருக்குன்னா கன்ஃபியூஸ் ஆகாம வேற பீரியட் யூஸ் பண்றதுக்கு யூஸ் ஆகும். ஓகேவா? நெக்ஸ்ட் வந்து in case dividend yield is given in the question, in case dividend yield is given in the question, what we have to do? What we have to do that we have to deduct the dividend yield from the risk-free interest rate. In case percentage is given in the question, we have to reduce the percentage from the percentage, that is risk-free interest rate per annum. Okay, dividend yield is also given in per annum basis. Then we have to reduce the interest-free risk. We have to deduct. Okay, it is very simple. The same formula we have to write. From R we have to deduct the D. Okay, in this formula also we have to deduct R minus D. In this formula also R minus D. Wherever we wrote R in the above formula, future price computation formula, we have to reduce or deduct the dividend yield percentage from the R. Then you will get the present value. Okay, this is not a present value, you will get a future price straight away. Okay, next, summary of forward and future pricing. In case of theoretical price, we have to compute. In case of without dividend, it is a summary. On exam date, you can remember, use this table to go through. Okay. In case of without dividend, the formula can be this. Also, with the face value and the dividend. Okay. With face value, we have to deduct the present value from the spot price. In case of dividend yield, we have to reduce from a risk-free interest rate in this one. Okay. Keynote: what type of interest method is to be used? Specifically mentioned in the question. In case specifically mentioned in the question, we have to use that formula. Okay. A simple interest or a continuous compounding or a monthly compounding. In case if nothing is given in the question, use simple interest method to be applied. If E value is given in the question, we have to use continuous compounding formula. Okay. Next, which compounding frequency to use in different situations? That is, you can read it on your own, but I will read. Continuous compound, risk-free interest rate is given. If continuous compounding is given, continuous compounding method has to be used. Daily compounding, so daily compounding also we have to use continuous compounding. E power value is given in the question, you have to use continuous compounding. 1 month interest rate is 12% per annum. 1 month interest rate is 1 month interest rate. The word 1 month interest rate is very important. It will be a monthly compounding. Okay. If question says 1 month interest rate equal to 12% per annum, it is for a per annum, but compounding will happen on a monthly basis. It is a hint given the question we have to use. Okay. Interest rate is 0.9% per month. So it is already given in a per month basis. There's also hint that we have to use monthly compounding. Next, interest rate is 2.4 per quarter. Then it is a monthly compounding or it can be a quarterly compounding. Okay. The month number of days or a T will differ. 2 month interest rate is 12.5 per annum. Every 2 months the compounding will happen. Otherwise, simple compounding. Okay. We'll take an example to compute simple interest, continuous compounding, and monthly compounding. A stock is currently trading at 1000. That is spot price. The spot price of the stock means shares. Okay, share is 1000 rupees. The risk-free interest rate is 6% per annum, and the contract matures in 6 months. T is 0.5 per year. Okay, 0.5 year. A dividend 20 is payable on the face value of the stock. Okay, 20 is payable. The time period for dividend payment is not given in the question. We have to assume that it is for a 6-month period. So calculate the forward price or a theoretical price using simple interest. First one is simple interest method. So what we have to do? First we have to compute present value of dividend. The present value of dividend in case of simple interest equal to dividend divided by 1 plus RT, or in case the present value is given in the question, we have to multiply it with spot price, the dividend into spot price. Then we will get the present value of dividend. So the present value factor is not given in the question. I have to use the formula D divided by 1 plus RT. 1 plus RT means nothing but the 1 divided by 1 plus RT is nothing but present value factor. Okay. So D divided by 1 plus RT will be computed equal to 20 divided by 1 plus 0.06. That is 6% per annum. So we have to divide 6 divided by 100. It will give you 0.06 multiplied with time, that is 0.5 years. Okay, half years. So 20 divided by 1.03, or we can also compute like this. The present value factor is equal to 1 divided by 1.03 will give you 1 divided by 1.03, 0.9708. Okay, this will be computed present value of dividend equal to 20 into 0.9708. So multiplied with 20 will give you 19.42. Okay, same answer we will get. It is nothing. Okay, simple mathematical calculation. D is given in the question. Instead of D, we will write 1 in this present value factor formula for 1 rupee. what is the 1 rupee value, present value of 1 rupee in case of future. This is the future value factor. This is the future value. Future value divided by future value factor will give you present value. Okay, factor. So to compute present value of dividend, we will multiply that present value factor with the future value. So computation of adjusted spot price. The spot price now will be 1000 rupees minus 19.42. Don't forget, okay, in case of dividend, it is an income. We have to reduce that income from the cash. The future theoretical price is a inflow for one person or a outflow. Okay, we have to, the dividend is a inflow, so we have to reduce from the outflow. Okay, in case of interest, it is a outflow. Okay, we will add that interest cost of carry to the spot price, then we will get a future price. Okay, dividend is a income, interest is the expenses, so income will be reduced from the future price, the spot price, and also interest will be added to spot price. We will get a value of future price. Okay, the adjusted future price is 980.58 multiplied with 1 plus RT, 1 plus 0.06 multiplied with 0.5, then we will get a value of 1009 as a future price. In case of continuous compounding, present value of dividend will be computed using D into e power minus RT. In the question, minus RT value, minus value is given, then it is a present value factor straight away given in the question. We can use that value for computation of present value of dividend. 20 into e power multiplied with 0.9703. So adjusted spot price will be 1000 minus 19.41 will give you 980.59. So computation of future price equal to spot price multiplied with 1 plus RT. 1 plus RT, not 1 plus RT, it is a e power RT. So e power RT value is given in the question. So we have to multiply it with the e power RT value, then we will get a value of 1010 rupees 0.47. In case of monthly compounding, present value of dividend D divided by, the present value of dividend will be calculated using D divided by 1 plus R divided by N whole power N into T. So the present value is calculated using 20 divided by 1 plus R is 0.06 divided by 12. That is number of months is 12 months. We will be converting this into 1 month period. So we will square the value by number of compounding period. That is 12 month into 0.5. This will give you 6 month period. Okay. By taking this, we will get a value of 19.41. So we have to compute adjusted spot price. What is the adjusted spot price? Spot price minus present value of dividend will be reduced. So to compute future value equal to adjusted spot price into 1 plus R divided by N whole power N into T. Okay. Then we will get a value of 10,000, not 10,000, 1010.38. Okay. In case of some question, will ask you market situation, that is contango market or a backwardization in forwards and futures. Okay, whether market in contango or a backwardization. Okay, definition: future price is higher than the spot price. If future price is higher than the spot price, the market is in contango market. If future price is lower than the spot price, then market is in backwardization. Okay, backwardization. Basis spot minus future. If it is negative, it is in contango. Okay. In case of positive, spot is more than the future price, it will be positive. So it is in backwardization. Okay. You can remember this. If it is future price is higher than the spot price, it is a contango market. If future price is lower than the spot price, then it is market situation is backwardization. This will give you 2 mark. In case of if some question asked for 6 mark question, then this can be part of the 2 mark. 2 mark can be part of from this. Okay. In our example, you can refer this example also. I will explain this example. In this case, the current price, spot price is 1000, but in case of simple interest compounding, future price is 1009 rupees. So future price is higher than the spot price, then the market situation is contango. Okay, price of one future contract. Okay, now in case of trading the stocks or commodities, there is a lot size is fixed. Okay, the lot can include number of underlying assets, shares or commodities. One lot can include units, more number of units. Okay, one lot, in case of purchasing one lot, will include 50 shares or 100 shares is included in a lot size. It is known as lots. Okay, the price of one future contract, the contract can be on a actually quoted trading price. Okay, it will be multiplied with the lot size. Okay, actual trading price of future multiplied with the lot size. Okay, what I mean by actually quoted trading price and also lot size, the market price which the future contract is currently trading. Okay, currently trading price is known as actually quoted trading price. If actually quoted trading price is not given in the question, okay, assume theoretical price we have computed. Okay, we have computed theoretical price using simple interest, continuous compounding and monthly compounding. We can use that price as a actually quoted trading price in case quoted price is not given in the question. Okay, lot size, the number of underlying asset in a one future contract. In one future contract it can be 100. One future contractல ஒரு contract, that is ஒரு contractல 50 shares இருக்கும். ஓகேவா, 100 shares இருக்கும். ஓகேவா, இது வந்து கொஸ்டின்ல எப்படி சொல்லிருப்பாங்கன்னா மினிமம் ட்ரேடிங் லாட், contract multiplier, trade multiplier, number of delivered in contract, number of times delivered in a contract, or number of shares or a unit in one contract அப்படின்னு கொஸ்டின்ல கொடுத்திருந்தாங்கன்னா நம்ம அதை யூஸ் பண்ணிக்கலாம். ஓகேவா, price of one future contract equal to actually quoted price of future multiplied with lot size. Okay, example, quoted price is 1500 per share. Okay, lot size is 100 shares. Okay, per share price is 150, 1500. Okay, the one future contract will be 1,50,000. You can enter into a contract for a 1,50,000 in the future market. Okay, you cannot buy one shares, 10 shares, you cannot do. Okay, you can buy only 100 shares in one contract in case of entering into the future contract. Okay, it is available at a minimum one contract price is 1,50,000. Okay, contract value or a total exposure value. What is the contract value or a total exposure value? We have computed one contract price. Now we have to compute the contract value. Okay, number of contract will decide the contract value. Okay, in case contract value is given in the question, we have to compute number of contract. This will be the balancing figure. If number of contract is given in the question, we will compute contract value. The contract value may not be given in the question. Okay, in this case the formula can be used for computation of number of contract and also for computation of contract value or a total exposure value. Okay, the price of one future contract is we have determined multiplied with the number of contract. The number of contract will be computed using this formula, the same formula, total exposure value, that is risk value. Risk value divided by price of one future contract. Risk value can be computed exposure value into beta. Beta will be multiplied with the exposure value. Okay, example, value of portfolio. Okay, if the investor has a portfolio of 15 lakhs, beta of the portfolio is 1.5, nifty futures index on the 20,000 rupees, lot size is 50. Okay, the price of nifty index actually trading price is 20,000, lot size is 50. 50 shares can be purchased, totally 50 shares can be purchased, but one share is 20,000. So we have to compute, first we have to compute price of one future contract. Price of one future contract equal to 20,000 multiplied with 50. Then price of one future contract will be 10 lakh. Okay, price of one future contract will be 10 lakh. Now we have to compute exposure value, that is contract value. The contract value will be 15 lakhs multiplied with 1.5, that is beta value, will give you 22 lakh 50,000. Okay, that is total exposure value. The exposure value is multiplied with the beta value will give you the total exposure value. Total exposure value divided by price of one future contract. Okay, that is 22 lakh 50,000 divided by 10 lakhs, that is price of one future contract, will give you 2.25 or two contract. This can be written as upward contract can be done. It can also be R3 contract. Okay, it can be a 3 contract also. In case of MCQ, you may lose the mark in this part. Okay, you can write a 2.25, 2 contract or 3 contract in the answer. You have to use R. In case of MCQ, you may lose the mark if it is not clearly given the options. Okay, or any information upward rounding off will be done, or downside rounding off will be done. If downside rounding off is done, then 2 contract. If upside rounding off is done, then it is a 3 contract. Okay, it will be given in the question, you can assume. Okay, generally upward rounding off will be done in case of derivatives. Formula for payoff on future contract. What do you mean by payoff? It is a profit. Sale minus cost. Okay, sale minus cost. For a long position, buy future first and sell later. Okay, in our example, Mr. A will enter into a buy contract. Okay, buy future contract, and later he will sell the shares in a spot market. Okay, that is buy future first, sell later. For this, what is the profit or a payoff gain in the contract? So profit equal to sales minus cost. In this case, what do you mean by sales value in case of long position? The sales value can differ in case of long position and buy position. Okay, the settlement price is nothing but price of future contract on maturity. Price of future contract on a maturity, that is actual trading price on the date of maturity. Entry price, initially contracted price. Okay, initially contracted price will be, in our example, we have taken 2 lakh, that is initially contracted price. The actual prices turns out to be 2,30,000. So payoff will be, in case of long position, payoff will be settlement price minus entry price into lot size into number of contract will give you the payoff, gain or loss. If settlement price is more than the entry price, gain. If settlement price is less than the entry price, it will be loss scenario. Okay, if I have entered into a price, entry price is to be low on the settlement date, I will enter into a entry price to buy the future. Okay, this is my cost. Entry price is my cost. In case of long position, entry price is my cost, settlement price is my sale value. So profit minus profit profit equal to sales minus cost. So sales value is settlement price, entry price is cost. If my cost is less than my selling price, I will get a profit. If my selling price is less than the cost, I will get a loss. Okay, I think you have understood. Okay, I assume you have understood the concept clearly. Next, payoff also computed in case the percentage is given in the question. Sometimes in my examination, ICAI gave settlement price also and also percentage of rise and fall. I have confused. Okay, last 6 marks in the examination. Okay, in case value of contract, we have computed value of contract. It can be multiplied with rise or fall percentage. Okay, if price is raised, then settlement price, contract value into price rises, then it is a profit scenario. If price is fall, In case of long position, it will be a loss scenario. Okay. Example for a long position. Example, entry price is 1500, settlement price is 1,60,000. Entry price is initially contracted price, settlement price is actually quoted price on the maturity date. Lot size 100 shares, number of contract 2. Most of the question, the all information may not be given in the question. We have to compute that. For conceptual understanding purpose, the examples are given in the concept book. You have to solve all the questions given in question bank for better understanding. Payoff equal to 1600 minus 1500 multiplied with number of shares, that is lot size, multiplied with the number of contract. So it will give you the profit of 20,000. In case of short position, Mr. B, it is a short position for Mr. B. Mr. B will, in our example, Mr. B sell the future contract. Okay. If both the party, one party has to buy, one party has to sell, then only futures and forward is possible. Okay. If he sells the future contract first, it is a market to, it can happen without a physical holding of share. Without share இல்லாமலே வந்து ஃபியூச்சர்ஸ்ல வந்து நடக்கிற எல்லா டிரான்சாக்ஷனுமே வந்து எப்படி வேணாலும் இருக்கலாம். ஓகேவா? பை அண்ட் செல் வித்தவுட் ஷேர்ஸ் எதுவுமே இல்லைனாலும் பை அண்ட் சேல் கான்ட்ராக்ட்ல என்டர் ஆகலாம். ஓகேவா? He can sell the future contract, also buy later. Sell future, buy later. What will happen? He will sell the future contract to the other person and he will get the money. Then he will buy the shares in the spot market on maturity date. Okay. Then the payoff, he has expectation. What is the expectation in case of short position? He has expectation that price will fall. If price falls, then he will get a gain. Okay. He will buy the shares at a future date and he will make the gain. Okay. Payoff can be entry price. In this scenario, entry price, that is cost. We have taken examples, profit equal to sales minus cost. Cost will be the sale price. He has expectations that sale price will decrease. So he has entered into a contract for a cost. Cost minus sale price, that is low price, will give you gain for Mr. B. Okay. Into lot size into number of contract will give you the total payoff. Okay. If settlement price, in case of Mr. B, settlement price is lower than the entry price, he will get a gain. Okay. If settlement price is more than the entry price, then he will get a loss. Okay. In case of short position, the percentage of rise or fall, if fall percentage is given, then gain. In case rise percentage is given, loss. Okay. Example, short position, entry price is 1500, settlement price is 1400, lot size is 100 shares, number of contract equal to 3. Okay. The payoff computation is 1500 is my entry price minus 1400 into 100 into 3. Okay. Then profit is 30,000. In this case, the person who takes the long position will get a profit of 30,000. If one person is taking long position, other person will take the opposite position, that is short position. So for other person, 20,000 will be loss. In this case also, if person taking a short position, he gets a gain of 30,000. The other person who take the short position will get the loss of 30,000. Okay. Summary table for payoff computation. Okay. The same is given in the table also. You can refer on last day of examination while revising the chapter. You can refer this also. Okay. Refer this only for quick revision. Note, if percentage increase or decrease given in the question, that is percentage increase or decrease is given in the question, plus means price rises, minus means price falls. Okay. So entry price multiplied with 1 plus sign will be used in case of price rises. Okay. Minus symbol is used in case of price decreases. Okay. Types of margin. This can be asked as a important question in the examination. Okay. 1 minute break. I will start after water break. Okay, let's start with types of margin in future contract. In case of future contract, we have discussed earlier that the settlement will happen on a daily basis. While discussing difference between forwards and future, we have discussed that daily mark to market settlement will happen. How to compute mark to market margins? In case of this, there are three types of margins are there. There are two types, and also we have a margin called requirement. Okay, first, initial margin. Initial margin is while entering into the contract, both the party has to deposit the amount to exchanges for a future settlement. In case of loss, the exchanges will adjust that amount. Okay, so there is no counterparty risk. To mitigate the loss, exchanges will require initial margin from the investors. Okay, initial margin, the initial minimum amount required to enter into a future position, that is in case of long position or a short position, we have to minimum amount has to be deposited. It will be a security deposit for a investor in exchanges, okay, to cover potential losses. Okay, initial margin can be computed using two formulas. Initial margin equal to futures price multiplied with lot size if initial margin percentage is given on future, that is contract price. If initial margin is given on a contract price, we have to multiply this future price into lot size will give you the contract price. Okay, contract price of one future contract. So, or it can be computed using the contract value multiplied with the initial margin percentage. Okay, or it can be computed using mean, that is average of historical price movement, daily absolute change. If in case of some questions, initial margin percentage is not given, but information relating to mean of historical price movement and also standard deviation of price movements is given in the question. We have to compute using this formula, that is mean plus, okay, mean plus 3 into multiplied with the standard deviation of price movement. Okay, formula you have to remember. Okay, mark to market margin. Okay, mark to market margin is in case of daily profit or loss settlement based on the price movement. Okay, daily price movement will happen. Okay, on the date of closing the market, which the exchanges will calculate the mark to market margin for the traded on the close of the market. So it will be calculated using mark to market margin equal to closing price of today minus closing price of previous day, that is settlement price. Okay, closing price of today minus previous day closing price into lot size into number of contract will give you the total margin amount. Okay, if I have taken this example, if closing price of today is 100, closing price of previous day is 90, multiplied with lot size 100 shares into number of contract 10. Okay, then it will give you 10,000 is a gain. Okay, Next is maintenance margin. What do you mean by maintenance margin? Maintenance margin is must be maintained before margin call is triggered. Okay, it can be from the initial margin amount or can be a contract value amount. If the account balance falls below the maintenance margin, okay, I have given you the example what is maintenance margin, but I'll tell you the theory. If the account balance while entering into the contract, you will pay the initial margin amount. Okay, your account will be monitored by the exchanges. In case your amount is falls below the maintenance margin, there is a maintenance margin will be fixed by the exchanges. If your initial amount or a amount in the margin account, okay, falls below the maintenance margin, that is, in case you have a 10,000 profit, you have initial margin of 15,000. Okay, then your balance will become 25,000. Then it is up to the maintenance margin. It is which is a below the maintenance margin. Okay, so you are not required to margin call. Okay, you are not required to call bring the call money. So it is nothing but maintenance margin, minimum margin amount that must be maintained before a call money is triggered. Okay, if the account balance falls below the maintenance margin, the trader must deposit more fund, margin call, up to a margin amount. Okay, while explaining the example, you will understand better. Okay, how to compute maintenance margin? If maintenance margin percentage is given on initial margin, we have to compute initial margin into maintenance margin percentage on initial margin. Or if the percentage is given on a contract value, you can use the contract value multiplied with percentage of contract value. Next, margin call requirement. In case the total amount in the account is falls below the maintenance margin, we have to bring the amount up to initial margin amount. Okay, how to compute this? Initial margin call equal to initial margin amount minus margin balance. Margin balance is nothing but initial margin plus or minus if gain or loss from the mark to market will happen based on the price fluctuation. Mark to market gain or loss will happen. That amount will be added with initial margin amount or deducted. In case of profit, initial margin plus profit. In case of loss, in price movement, there is a loss. So initial amount minus loss amount will give you the amount. Okay, that is margin balance. Margin balance, if margin balance falls below the maintenance margin, investor has to bring the amount up to initial margin amount. So initial margin amount minus main margin balance will give you the margin call, that is call money. So margin account statement format எப்படி கண்டுபிடிக்க போறோம்னு போட போறோம். அதுக்கு ஒரு எக்ஸாம்பிள் இருக்கு. எக்ஸாம்பிள் பாத்தீங்கன்னா ட்ரேடர் என்டர் இன்டு a long future contract, long position has taken. So in case of long position, we have the payoff computation. Payoff is nothing but mark to market margin. Okay, so initial margin required is straight away given in the question 15,000. Maintenance margin is 11,250, that is 75% of initial margin. Lot size 100 shares and contract is for one contract. Entry price is 1,500. Day 1 and day 2, that is entry price and also day 1 price is same. Okay, in case of day 2, day 3, day 4 is given. To calculate mark to market margin, to compute mark to market margin, margin balance, call money if required, and closing balance in the margin account for each day, and compute payoff. Payoff computation is nothing but mark to market margin. On first day, we have opening balance of 50,000 in the margin account. Investor margin account will have a 15,000 of initial amount. So there is no mark to market margin in case of first day. Okay, the price on the date of on closing day also 1,500. There is no call money required. Okay, also closing balance of the margin balance, closing margin balance is 15,000. So on second day, opening balance will become the yesterday's closing balance will become opening balance of today. So mark to market margin we have to compute. Okay, mark to market margin, closing price of today minus previous day multiplied with the contract size and the contract number of contract, lot size and contract size. So the prices payoff is on day 2. Day 2 closing prices 1480. So closing price of today 1480 minus 1500 will give you minus 20. Minus 20 will be multiplied with number of contractors for one contract into 1 into lot size is 100 into 100. So there is a 2000 loss. Okay, for a long position, we have to use this formula: settlement price minus entry price into lot size into number of contract. Settlement price is 1480 minus entry price is 1500. In this case, loss will arise. Okay, loss will be 2000. So opening balance plus daily mark to market gain, that is will give you 13,000. 13,000 is my balance after adjusting the margin. So my maintenance margin is 11,250, but the balance is 13,000. There is no require to bring the money into account. So closing balance is 13,000. In day 3, opening balance will become yesterday's closing balance, today's opening balance. So computation of mark to market margin. Today's price is 1,450. That is my settlement price today. My yesterday's price is 1,480. So 1,450 minus 1,480. That is 30 rupees is my loss multiplied with 100. So I will get a value of 3,000 is my loss. So 13,000 minus 3,000 will give you 10,000. What happened? I have not maintaining the maintenance margin. So my balance is below the maintenance margin. Okay, my margin balance becomes below the maintenance margin. So I have to bring the money into my account up to my initial margin amount. Okay, that is 5,000 I have to bring. Okay, my initial margin is 15,000. 15,000 minus my balance after adjusting the maintenance mark to market margin. That is 15,000 minus 10,000 will give you 5,000. Okay, then my balance become 15,000. Now what I have to do? After 4th day, on the date of 4th day, my balance is 1,470. 1,470. So 1,470 minus 1,450 will give you 20 rupees gain. 20 rupees gain. So 20 into 100 will give you 2,000 gain in this scenario. So 2,000 gain means 15,000 plus 2,000 will give you 17,000. So there is no requirement. Amount is not above the initial margin. So not required to bring any call money. Closing balance also 17,000. On 5th day, the price is 1,485. Okay, 1,485 minus 1,470 will give you 15 rupees gain. 15 for one share into 100 shares will give you 1,500. So 1,500 plus 17,000 will give you 18,500. There is no requirement of call money. So now, while adding this amount, we'll get a payoff, total payoff. On the date of maturity, what is my gain? The question can ask you, what is the gain on maturity? This can be asked from this can be computed using by totaling it. We will get a value of total payoff on maturity date. Or you can compute the gain or loss by 100 into one contract, that is lot size into contract, number of contract, price, entry price is 1,500. The contract price on 5th day. 5th day is the 485 minus 1,500 will give you 15 minus 15. So my loss will be 1,500. Or you can compute using this formula. Closing balance of margin account at the end. Closing balance is 18,500 minus initial margin, also what amount? That is my inflow. Okay, this is my inflow, that is 18,500 is my inflow, my balance. This is my outflow. Okay, initial margin and call money is my outflow. I have paid the amount to the stock exchanges to maintain my balances. So my deposit is 20,000. So 18,500 minus 20,000 will give you 1,500 loss. There are 3 ways to compute the total payoff. You can add this, or you can compute payoff formula. Okay, long position. In case of long position, settlement price minus entry price multiplied with lot size multiplied with number of contract. Okay, let's move to hedging using future index. Using future index. Okay, let's start with hedging using future index future. Okay, hedging with the index future helps the investor to protect their portfolio or shares from the market movements. Okay, price movements from the market movements. Okay, I have already holding the portfolio of shares or shares. Okay, if I have a portfolio, I can invest in a index future. If I have shares, I can also invest in a index future to protect myself from the getting loss in case of future price movements. Okay, first one is there are steps to compute the hedging. What you have to do? First, we have to determine which position to create in the index future. Choice of position depends upon expected market movement. If I have an expectation that price will decrease or a price will increase, then I have to decide what position I have to take to protect my getting loss or a gain. So wants to hedge the against the gain or loss. Okay, if investor holds the stock portfolio, I am already holding the stock, that is long position. I have taken a long position in the stock. He expects that market will decline. Okay, market price will decline. Then what I have to do? Opposite position I have to take, that is short position in a index future. If I have a long position in the stock portfolio, now I have expectation that market will decline. Okay, expect that the price of the market will decline. Then I have to take opposite position, that is short position. If investor has a short position, okay, you can ask எப்படி வந்து ஷார்ட் பொசிஷன் வரும் சார்? ஷார்ட் பொசிஷன் இருக்கு, ஓகேங்களா? நீங்க வந்து ஆப்ஷன்ஸ்ல ஃபியூச்சர் ஆன் ஆப்ஷன்ல போனீங்கன்னா you can take short position also can be possible. If one person is taking a long position, another person will have a short position. So in this case, the person who taken that short position, that is sell the index, he expect that the price will rise, so he has to take a long position in the index. Okay, if person having a short position in the current market, expect that price of the shares will raise, then he has to go for a long position. In this case, if you are entering into a hedging, then there is no loss for you. Okay, then the loss will be killed by entering into the hedging the portfolio. Hedging a long portfolio is long in stock. Okay, if I have purchased the shares, I have shares, then need to sell the short position. Okay, I will take a short position in the index future. If I have a long position in the stock, I need to take a short position in the index future to hedge against the market decline. Okay, first I have expectation that price will increase, so I will go for a long position in the current market in the shares. Then after that I have a fear that price will decrease. Okay, so I will enter into a contract for a index future hedging, so that I will take a short position, that is opposite position of whatever position I have. Okay, in case of a long position, I will take a short position in the future market. In the stock market, I have a long position. In the index market, that is index future, I will hedge the shares by taking short position. Okay, in case of market decline. Okay, I will explain in terms. Okay, first on day one, I have entered into a contract, in a future contract, that is derivative contract. First day, I have an expectation that Geo shares, okay, Geo shares price will, I have a long position, I have taken long position, okay, in the Geo shares. On day 3 or day 5, on day 3, I expect that price will decrease in day 5, okay. On first day, I have an expectation that price will increase, so I have bought the long position, okay. On day 3, I have expectation that price will decrease. What I have to do? In this case, I will go for a short position in the index market, okay. Share the index, okay. To hedge, I will take a short position to hedge the losses. I have expectation that price will decrease. On day 1, I expect that the price will increase, so I bought the long position. On day 3, I have expectation that the same price will decrease, so I on the date of day of 5th, okay, so I will go for a short position in on day 3. So net, in case of this, the loss will be protected by hedging. The loss will be protected. If I take a long position, actual day the price can be decrease or increase. In both the scenario, I will make a zero loss. That is simple. Hedging is done for a protect the loss or a gain. If long position get the gain, that gain will be adjusted with the short position. That's it. Okay. Okay. For a short position, I will take a break. Okay. We'll stop this.